I'm Alison from FX Scouts. In today's video, we're going to be discussing what spreads are, how they affect your profitability, and why you should choose a broker with low spreads. In the world of forex trading, brokers typically earn their money in two ways, either through a spread or through charging you a commission. A spread is basically the difference between the bid price and the ask price that you see on your trading platform. For example, as you can see here, the bid or sell price is 1.07217, while the ask or buy price is 1.07226. So this basically means that if you bought the Euro USD for the quoted bid price and immediately closed your position, which is effectively selling the asset, you would pay the spread, which in this case is 0.9 pips. So you would make a loss of 0.9 pips because you would have to pay the broker to open that position. So the spread is essentially the broker's profit on each trade a trader makes. Now, in order to understand how to calculate the spread, you're going to have to understand how to calculate your pip value. And this is a subject that I cover in a lot of detail in another video, and I'll pop the link to that video in the show notes below. Now, on the other hand, a commission is the fee that a broker charges for opening and for closing a trade. And it can either be a fixed fee or it could be a percentage of the total volume traded. So a broker who has a low spread typically has a spread that is very close to the market price, which means that the bid and the ask prices are very similar. And traders will find this very attractive because it'll obviously reduce their trading costs. So if you work out the amount that you are charged in terms of the spread, it can look very insignificant or very small. But these costs can often build up over time and become quite significant. And this depends on the size of your trade or your position size, and it also depends on whether you're using leverage or you are trading on margin. So here you can see that the Euro USD has a spread of 0.8 pips, and you can see this if you subtract the sell price from the buy price. And if I trade a volume or open a position size of 0.01 lots, which is a contract value of €1,000, then I'll pay a commission of 0.07 euros or around $0.075, which seems like a very small amount. And it is, depending on how many times you open and close your trades. So if you open a position with the same broker and the same spread, but on a position size of one lot, which is equivalent to 100,000 euros, you will pay much more. This means that to open and close a position, no matter how much profit you make or how much you lose, you'll pay the broker around 100 times that amount, the amount from the previous lot size of 0.01 lots, because you've opened a position size 100 times bigger. Now, as you can see, the spread increased between the two times I opened the different positions from 0.8 pips to 0.9 pips. But still, the principle stands that if you open a bigger position size, you will obviously pay more in terms of money, but not more in terms of the spread. The spread remains the same, but you'll obviously pay more because your position sizes are bigger. Now, spreads are not only determined by how much the broker charges you, they're also determined by the market liquidity. And during normal market conditions and during times when there is more trading activity taking place, say during the London or the New York trading sessions, the price of the spread will remain relatively stable. And you'll also find that the most heavily traded currency pairs will have the lowest spreads. And the most heavily traded pairs tend to be the Euro USD, the GBP USD, and the USD JPY, while emerging markets like the USD ZAR or dollar rand are much more expensive to trade because they have much less liquidity and they're not traded as often. In other words, the more liquid the market or the more a certain currency pair is traded, the narrower the spread. And this is because the high volumes traded generate lots of profit for the broker, even though the profit margins might be narrow. If, however, there is a big difference between supply and demand, or there is decreased liquidity in the market, such as when there's a major news event like the increasing of interest rates or decreasing of interest rates, or there's a news announcement about inflation in the various countries, you might see a major increase in the spreads. So if you have a look at the dollar-yen chart here, you'll notice a gap of around 80 pips from the market close on Friday until the market open on Monday. And this was in the wake of comments from the Bank of Japan governor that increased expectations the central bank could shift away from its negative interest rate policy. And it was also a result of the fact that US inflation data, due to be released at the end of the week, was decreasing. And to cope with the huge sell-off of the USD JPY, the broker increases the spread or the difference between the bid and the ask price to cope with the huge volatility and possible illiquidity. So just to go into a bit more detail and give you more insight into why it is beneficial to trade with a low spread broker, I'm going to give you another example. Let's say you wish to trade the GBP USD and your broker is offering a bid price of 1.24641, as you can see here, and an ask price of 1.24656. The spread here is therefore 1.5 pips. If you were to buy the GBP USD and attempt to sell it straight back to the broker, you would immediately be in the red due to the 1.5 pip difference. So you would therefore need the GBP USD to appreciate by at least 2 pips before you could sell and make any profit. Low pips mean lower barriers to profitability. So if you're concerned about your bottom line and you want to ensure that you are paying a fair market price, then you may want to have a look at the list of brokers that we've created below. I'll pop a link to the list of brokers in the show notes below so that you can go and check them out yourself. But these brokers are all well regulated and they do have some of the lowest trading costs in the industry. Thank you so much for watching. If you have any questions, please don't hesitate to write to us in the comment section below or go and visit our website at fxscout.com.